Okay. This session, what we're going to do is just take a moment out, and we are going to do a couple of problems. We're going to take a break from covering the materials. We've covered quite a bit of materials at this point. We only have a chapter left along with some additional materials. And so I wanted to take some time out just to do some problems where you can get familiar with the tax returns and filling out the forms. You may have software to do this, but it always helps to know how the form should work and flow, and then that way you are confident that the tax return that came from your software is correct. We want to start with a problem at the end of chapter 3. It's on page 3-4, and it's problem 2A. Dr. George E. Beeper is a single taxpayer. He lives in Spokane, Washington, and then he works for Pine Medical Group, and his earnings and income tax withholding for 2008 are such. I pulled up a W-2 on IRS.gov just so you can see generally earnings is going to be reported on a W-2. Of course, in these problems, they just give you the amount of the earnings, the amount of federal income tax withheld, and state withheld. And we're just going to focus on the federal return. So if you look here, I've pulled up the W-2, and generally the total wages and tips, which would be the $116,000, would be reported in box 1. And the federal with income tax withheld, his $25,000, would be reported in box 2. Then if you go all the way down to 15, box 15, you would have state, whatever, Washington, state wages, and state income tax would be whatever, but he happens to have 0. So I just wanted you to know and be aware that typically the earnings is going to be reported on a W-2 for an employee. Okay, so let's go and begin to prepare the income tax return. Okay, you always want to, of course, we'll put his name, George. I've already put Beeper in. So also in your book, they have these blank pages, and so you are welcome to fill along, complete this along with us. We would put in his Social Security number. You must have a Social Security number. And then we would put in his address, which I won't do at this time. It's just him. So he's filing single as far as I know. And he has no other dependents. So we're going to claim 1 for himself and 1 total. Okay. So then we want to, I'll zoom in a little bit so you can see those. We want to start with his wages or his own earnings from Pine Medical. And it was $116,000. So those wages in items are going to go on line 7. They're going to go on line 7. The federal tax withheld, the amount that's been withheld from his paycheck, it goes back under payments. That represents a payments, which we're still going to cover a chapter in payments. But notice that line 62 says federal income tax withheld from W-2s and 1099s. So that's where the $25,000 goes. Okay. So next, if we go ahead and review the problem, it tells us that Dr. Beeper owns a rental house located at 672 Lake Street Drive. So he has rental property. The house was rented for $1,000 per month and was rented for the entire year. So rental, if you look here on the front of his return, goes on Schedule E. Line 17 says rental real estate royalties partnership. Attach a Schedule E, and then that amount will go on line 17. So you should have a Schedule E, and so we're going to fill out a Schedule E for his income. Okay, he had $1,000 a month, so we want to fill that out here at the top. Rents received, and on line 3 for property A, we're going to put the $12,000. He said it was rented the entire year. Okay, then we want to go ahead and put a description of rental property A, and it was just residential rental. So I'm just going to put rental, and I'm going to put the address. It was 672 Lake Street. 672 Lake Street. And so that applies to that particular one. It has a question for each. If you remember when we did our rental, we had questions like, was it rented for more than 14 days or greater than 10% of the rental days? And so to determine if this is primary rental, is it rental personal split, or is it primary personal? Those particular questions appear there. It says for each rental real estate property listed on line 1, did you or your family use it during the tax year for personal purposes for more than or greater than 14 days or 10%? In this case, no for A, because if you remember, they said that it was rented the entire year, so we didn't use it for any personal. So this here area takes care of that, whether it's going to be a total rental or a rental personal split. Because remember, if it's total personal and I had some rental, then I don't have to report the income or the expenses. I wouldn't be filling out one of these forms. Okay, so we have on there, we have our rental income of $12,000, which is the $1,000 per month. Also, they said we had real estate taxes of $3,500. And so we're going to go down to line 16 for our taxes of $3,500. It says also that we had mortgage interest of $12,500, and that's on line 12. Mortgage interest paid, $12,500. And then it had $900 of insurance. And see, since this is all rental, we don't have any personal to subtract out. Then it says depreciation. Assume that it was fully depreciated. It said that it was purchased in 1965, so there's an opportunity that it was fully depreciated. So we're going to go ahead and put a 0 on our line 20, which is where the depreciation would go. Next, $1,000 for gardening. We're going to list that as other. Amount we had to pay for gardening on line 18. And then we had repairs of $600. Repairs go on line 14. And then we had maintenance of $3,636. Maintenance is on line 7. Okay, so I believe those take care of all the amounts that we have. When we total up our expenses, we get $22,136. $26,136. Now, before we continue to add up those, we have this total column over here. We had total rents of $12,000 that we want to carry on. That's if we had more than one rental. We would show those totals all the way across. They asked us for the total of line 12, which is the mortgage and interest. And then they asked us for the total, which is $22,136. Okay, and then we had no depreciation, so the total on that column would be the same. Okay, so then we take our $22,136. We had no depreciation, so our total expenses are $22,136. And then we come up with our net income. If we had $12,000 of rental income minus the $22,136 of expenses, we would end up with a $10,136 loss. And so that would be the loss that we had. So it tells us that if we have a loss, we need to fill out an 8582, which is the passive loss form, And if you remember, there's some limitations on passive losses, but then remember there was a $25,000, up to a $25,000 loss that we can take for real estate rental. Okay, so let's look at our 8582, which is our passive loss form that we must fill out. It's not a difficult form to fill out, but it is necessary so that we can make sure we can deduct that full rental loss. Of course, at the top, you always fill out the name. Here we have George Beeper. And then we would fill out his Social Security number there. Okay, So as we go through and we read our lines, line 1B asks us for activities with net loss from our rentals. And so we had $10,136 as a net loss. We had no other items in that area, so we carry that loss down, $10,136. And we had no commercial revitalization and no other passive activities. The rental is our only passive activity, so those other items are zero. So line 4 ends up being the loss of $10,136. Ends up being our loss. So now at the bottom in part 2, it says that this is for a special allowance for rental real estate activities with active participation. So we're going to assume that he actively participated. Enter the smaller of the loss on line 1D or the loss from line 4. It's the same loss, so $10,136 is our loss. And then it says if you are enter 150, and then if married, filing separate, we would enter a different number, but we are not, so we're going to enter the $150,000. It says enter your modified adjusted gross income. We're going to enter that, which is the $116,000. That's before we enter the real estate loss. And then they say to get the difference. Take the 150 minus 116. So we would end up with $34,000. And then it's on line 9. It says multiply line 8 by 50%, which is $17,000. And then on line 10, it tells us to enter the smaller of line 5 or line 9. Okay, and so that would be the $10,000, 136. And so therefore, we would be able to take the $10,136 loss. Okay, so that amount would carry forward to my tax return, to the front, to the front page of my tax return. So let's go put that in. Remember, I already spoke about line 17 being your line in which you put your real estate loss on. Okay, so line 17, we would show $10,136, and we want to show it in brackets to indicate that it is a loss. So that's how we do the rental real estate, and when we have a loss. Okay. Also, they tell us that during May of 2008, Dr. Beeper transferred $67,000 out of his Section 401k plan from a former employer, the Elm Medical Group, to an individual retirement account with the Spokane State Bank. The transfer was made directly from Section 401k plan. So that means it was a direct rollover. He didn't receive a portion of it. So that is a total non-taxable rollover for him. He probably received a 1099-R indicating that it was a rollover. So it would go on line 16A. We would put the $67,000, and then the amount that would be taxable would be zero in that case. So then when we have completed basically all our supplementary information, so we just begin to fill out the information. 116 minus the $10,000 loss gives us a total income, of $105,864. And then we had no adjustments to our income, so we end up with the AGI of $105,864. Okay, we carry that adjusted gross income to our second page, and we would carry that, and then it would be the $105,864. Okay, he is filing single, and so if you even notice on the side of your form, the standard deduction, they didn't mention any itemized deductions, so we're going to allow him to take the standard of $5,450. That gives us $104.14. And then it's just him, so he's going to get an exemption just for one person. And so that gets us down to $96,914. And so that represents his taxable income. Because he is under $100,000, he can go to the chart and get his tax. The tax would be $21,117. We have no other adjustments or credits or an additional taxes, so we would just basically flow that number on down because we have no additional items or anything else to consider. And so once we get there, we know that he owed $21,117 in taxes. He had withheld $25,000, so he is due a refund of $3,883. If he fills out this section, he can have it directly deposited in his bank account, or he can have it a portion of it applied to 2009, or he can just simply have them send him a check. He can have it, if he owes back taxes, they typically will hold that and take care of that. So that is the problem 2A on page 3-4. Just wanted to get a little practice in completing a tax return that had real estate to it and being able to fill out that passive activity loss form. Okay, now we want to move to chapter 5. We didn't cover anything in chapter 4, so we want to move to chapter 5 and complete a tax return. Okay, I want to, let me get to the right form. We have 2 that we're going to do at the end of this chapter. I want to start with page 5-48, and we want to do B. Jones. We want to do B. Jones. Okay, so we want to start there. And so you should have another form in the back of this chapter, or you can go to irs.gov and get the information as well. We're on page 5-48, problem 2A. B. Jones, who's 32, she moved from Texas to Florida in January. She lives in Gulfport, Florida, and then they give us her Social Security numbers. Her earnings and income tax for her job was as follows. She worked for Gulf Shrimp, and she earned $42,000. So we want to, you would fill out the top. We're going to forego filling that out. We know she's single. We didn't indicate any other exemptions or anything, and so she would just claim 1. Okay, so we want to start off by inputting her $42,000 there. She had income tax withholdings of $7,800. So remember, that goes on our second page on line 62. So I want to go ahead and put that there. That represents the amount of income tax she had withheld. Okay, it says B's other income includes interest on savings account at Beach National Bank of $2,200 and $600 per month alimony from her ex-husband. So she received alimony from her ex-husband. And so let's put in her interest of $2,200. Okay, we put it there, but you should also fill out, we put it here on line 8A, but we should also fill out a Schedule B for her interest income. And so let's go ahead and do that, and then that flows to the front of your tax return. This interest was from Beach National, so we want to fill in the name there. And Beach National Bank for $2,200. And then that would carry down to line 2. And then on to line 4, because we don't have any others. And then that would go ahead and go to the front of the tax return there on line 8A. On line 8A. Okay. So, any questions up to that point? Make sure that as you go through there, you deal with each item. The best way to do these problems, because you will have to do a problem for your final. Your final is a tax return problem. And because you have so much information, what I try to do is I deal with each information as I read it and not say I'll come back to that as I come across the earnings. I put it where it needs to be. As I come across the federal income tax withheld, I put it where it needs to be. As I come across the interest income, I'm going to put it where it needs to be. And next, the alimony. Remember, alimony is taxable to the person receiving it and is deductible to the person's paying it. She received $600 a month alimony, so she received $7,200, and that is going to go on the front of the tax return. On line 11, it says alimony received. Alimony received, so it will go on line 11. That's going to be income to her, and the spouse that's paying it is going to be able to take a deduction for it. During the year, B paid the following amounts, all of which can be substantiated. So she has the necessary documentation. And it looks like the majority of these are Schedule A, or miscellaneous itemized deductions, I'm sorry. So let's go to a Schedule A and begin to fill out the Schedule A. You would always fill out the heading. To save time, I'm not going to do that. and so the first thing on our list is mortgage, home mortgage interest of $9,700, and that goes on line 10. And then next we have auto loan interest. You cannot deduct auto loan interest, so we would not deduct that. Next we have property tax on personal residence. That's deductible under real estate on line 6. Okay, next I have state and local taxes actually paid during 2008. And so she has some state and local taxes that she paid, so that would go on line 5. Okay, next we have unreimbursed hospital bills. So she has $3,200 of hospital bills. She have $2,550 of doctor bills, and then she has some other medical expenses of $720. She would be able to take the unreimbursed hospital, which is $3,200. She would be able to take the doctors, $2,550, and then plus the other. They don't say that they're non-deductible, so we're going to assume they are. And they would go here on line 1. Okay, and then remember they're going to be limited to 7.5% of our AGI, and we're going to hold off on that and make sure we have all items already filled in that will help compute her AGI. So we're just going to hold off on computing that and can finish filling out the form, and then we will get back to that piece. Okay, next she had income tax preparation fees. So remember, you can deduct those as miscellaneous deductions subject to 2%. So the $600 for tax preparation fees will go on line 22. And then she has job hunting expenses of $925 and union dues. So we would put those both here on line 21. So I would indicate these are union dues and job hunting. And I'm just going to add those together. And I would get $1,725. Okay. No other items there for miscellaneous. So I would subtotal those. For line 24, I would get $2,325. And once again, this is going to be limited to 2% of the AGI. So I'm just going to hold off and just double check that I have everything already for my AGI. Okay, in July of this year, it says somebody broke in B's house and stole a diamond ring. The diamond ring had a fair market value of $10,000 and a tax basis to B of $8,000. The ring was uninsured. Okay, so given that it's a casualty or theft loss, in this case it's a theft loss, so we can take it as a theft loss. And because it's not something she lost and she can't find, so she assumed stolen, she actually knows that it's stolen. So therefore, casualty and theft losses, we fill out a form 4684. So let's go ahead and fill that out. We will fill out the heading with her name and Social Security. Then property A, they have enough for 4 items here, but property A, we're going to say it was her ring and it was stolen. And you can go on and say from the residence or whatever the case may be. And we want to put the date that they gave us, a date of in July. So we'll say July is when it was. And what else did they tell us? Stole a diamond ring, fair market value of $10,000. Okay. So then it tells us that the cost of her basis, it told us that it cost her $8,000. That was the cost of the ring. Okay. She had no insurance. So that line would be blank. No gains or anything from any other casualties. Fair market value of the item before the casualty, line 5, would be $10,000. Fair market value after the casualty would be 0 because it's a total loss. And so when we do that subtraction, we have a $10,000 loss. And then in 8, it says enter the smaller of line 2, meaning the basis or the decrease in fair market value. And the smaller would be the $8,000. And then subtract line 3, which would be the insurance. Since I had no insurance, it would be the $8,000. And so therefore my actual casualty or theft loss would be the $8,000. And remember, we have to reduce each loss by 100, and each loss by 100. And so then that would get me down to a $7,900 loss. And then I have no other casualties or anything like that. Okay, and then we want to get all the way down to line 16. And then it's going to be limited to 10% of the AGI. So once again, we want to wait and see what that AGI, make sure I've covered everything on the list before I move on. Okay. Next, B incurred the following expenses during the move. Because remember, she initially said that she made a move from Texas to Florida. And remember, moving expenses are deductible. So she had the cost of moving her furniture, transportation. I believe she's going to meet the mileage test if she's moving from Texas to Florida. And it says transportation, lodging, and meals, and a house hunting trip before the move. And so in order to deduct the moving expenses, we want to fill out a Form 3903, which gives us a place to record the expenses. And then remember, those moving expenses are a deduction for AGI. I like the moving form that it tells you right before you begin. It says to see the distance test and the time test. So make sure you meet that 50 miles or more distance test and the working time test that you have. Okay, so first thing they asked us is for the transportation. She had the cost of moving the furniture, transportation, and storage of household goods. So that would be $3,300. And then her transportation at 19 cents a mile was 1,511 miles. And then she had lodging included in that. So we have travel from your old home to your new home. Do not include meals. So that's going to be the mileage and the lodging that she can take. She cannot take the meals. And so the deduction for that is $537. Okay. And like I said, the meals are not deductible, and her house hunting trip before the move is not deductible. So she would get the $3,300 plus the plus the $537. So her total moving expenses would be $3,837. Her employer didn't pay any of those expenses, so she would get to deduct the full $3,837 on the front of her return. So let's put that on the front of our return. Remember, moving expenses is a deduction for AGI, meaning to get to my AGI. So moving expenses would be on line 26 here, where we have moving expenses, and it's coming from our Form 3903. So we put the $3,837. Okay, and then that's it. That's all we have. And so now we can go ahead and figure our adjusted gross income. We had wages of $42,000, $2,200 of interest, $7,200 of alimony. So we get total income of $51,400. And then the only adjustment to income we have is the moving of $3,837. So if we take our $51,400 minus our moving, we get adjusted gross income of $47,563. $47,563 is our adjusted gross income. And so we carry that to the top of the page. $47,563 is our adjusted gross income. The next thing they want is our itemized deductions. So we need to go to our itemized deduction sheet, and we need to complete filling that out, because remember, we stopped. Right here it says to enter the amount from line 1040, line 38, and that is the AGI that they want there, which is our $47,563. And then they tell you to multiply that times 7.5%, and we get $3,567. And so therefore, the amount of medical that is deductible would be $2,903, which would be the difference between the actual minus 7.5% of the adjusted gross income. Okay. Next, we would have $4,700 for our taxes. We would have $9,700 for our mortgage. And then we actually have a casualty loss. So we need to go back to our casualty loss form. And remember, the casualty loss is limited to $100 and 10% of the AGI. So let's continue to fill out this form. And let's put in all the way down here on line 22, they're asking for 10% of the AGI. Remember, our AGI was $47,400. $4,563, I believe. So 10% is $4,756. And then, so we would limit that. We would take $7,900 minus $4,756. And so the deduction for her casualty would be $3,144, would be $3,144. That's the amount that would go on the front of the return. So she would get a deduction for that amount. Okay. And then next we have our miscellaneous, which is limited to 2% of the AGI. So we would put our $47,563 here. 2% of that would be $951. And so we would get $2,325 minus the $951. So we would get $1,374 of miscellaneous deductions. Okay. So we would get medical of $2,903. We'd get taxes of $4,700. Interest paid of $9,700. Casualty of $3,144. Miscellaneous of $1,374. And the total of our itemized deductions is $21,821. We're not limited due to high income, so we would be able to take the full $21,821, and that would go on the second page here at the top of your 1040. So this is where you put either your standard deduction amount or the itemized. She is single. A single person can only take $5,450. So needless to say, we want to take her $21,821, and that gets us down to $25,742, and then it's just her, so she's going to take $3,500 of her exemption amount, and then that gets us down to taxable income of $22,242. And so we had no other credits or anything, so our taxable income is $22,242. If you go to your table, the tax for a single person there would be $2,933. We have no other adjustments, so $2,933, and line $2,933, and she had $7,800 withheld, and so therefore is going to receive a refund of $4,867. And once again, she can have that check mailed to her. If she fills out the banking information, she can have it directly deposited. She can have it applied to the to the next year. Or if she owes an amount for previous year, generally the IRS will take that refund amount. Okay, so that is a problem that dealt with moving, dealt with what to do with alimony, dealt with the casualty loss, Schedule A, and that was really pretty much it. We want to do one more. We may not get it completed, but we will at least get it started. We are going to do problem 1 on page 5-47. This is also a problem from chapter 5, and I will post these problems or give you the answers to them just so that you can take some time to practice to do them. This is John Williams. John Williams is a single taxpayer, lives in Reno, Nevada, and they tell us his earnings. Now, this is a high-income taxpayer, so this is one of the reasons I want to make sure I post this one, because he is going to hit some limitations. And as I said, we probably won't get to finish it, but I will post the answer out on the website so you'll have it. Okay, we want to start off with his wages. He had wages of $186,800 from Lucky Ace Casino, so we want to go ahead and put it on line 7. Here are total wages of $186,800. Okay, and then he had federal income tax withheld of $24,800. Remember, that just goes on the second page here, $24,800. And then John's other income includes interest on savings from Nevada National Bank of $13,075. So remember, we're going to put it here, $13,075. And then also we're going to put it on Schedule B. He meets that income limitation where he's required to fill out a Schedule B. So we just want to put it there on Schedule B. And this was from Nevada Bank. Nevada National Bank, actually. And it was $13,075. I'm sorry. And then we want to carry those amounts on down. So that's all he had. $13,075 and $13,075. Sorry, we just carry those amounts down, and then you go ahead and put them on the front of your return. Okay. Next, it goes on and says John pays his ex-wife $4,000 per month. So this is a situation where the last case was receiving alimony. This individual is paying alimony. And down at the bottom on line 31A, you have to put the Social Security number of the spouse that you're paying. And we are Social Security number, they give it to us, of the ex-spouse. And that's important because the IRS is going to want to cross-track and make sure that that taxpayer, that spouse, is including this amount in income. He paid $4,000 a month in child support. Now let's read that. $4,000, not in child support. It just says he pays his ex-wife $4,000 per month. When the 12-year-old child in the wife's custody reaches 18, the payments are reduced to $2,800 per month. So that lets me know that the alimony is really $2,800, not the full $4,000. So that's how we get $33,600. It's because if the amount is going to drop from $4,000 to $2,800 after the child reaches 18, that means that difference was actually child support. So that means $1,200 of it is child support and $2,800 of it is alimony, because that continues after he reaches 18. During the year, John paid the following amount. So that's going to represent his Schedule A. That's going to represent his Schedule A. Okay. The Schedule A expenses: home mortgage interest. He had credit cards and auto loans. He had auto insurance. The only thing that we can deduct from what I've just listed is the home mortgage. We can deduct that. The home mortgage interest of $19,700. So let's fill that in. Okay. Cannot deduct the credit card interest, the auto loan interest, or auto loan insurance. Auto insurance. He can deduct the personal property taxes on his residence of $6,200. So those are real estate taxes, actually. He can deduct state and local taxes that were actually paid of $4,000. The Blue Cross health insurance premiums of $1,800, that's deductible, along with his other medical of $790. So when I add those two together, I get $2,590. So he can deduct that. Well, we'll see the amount in excess of his 7.5% of his AGI. And then he had charitable contributions. He had the Boy Scouts, so we should be able to deduct that. That's $800. He had St. Matthew's Church of $300. He should be able to deduct that. University of Nevada, Reno Medical School of $10,000. That appears to be okay. Nevada Democratic Party cannot deduct. Fundraising dinner for the Reno Auto Museum. The value of the dinner is $50. He made a contribution of $100, so $50 of it is taxable. So his contributions is going to be $11,150 for his charitable contributions. Okay. Then what else did we have? That looks in his spare time. It tells us that John wants to become a famous photographer. Person to this desire, he runs a photographic business and incurs the following expenses. He has depreciation of $450. He has film and photographic supplies of $2,650. He has travel to locations to take pictures of $1,450. And then if we turn the page, during the year, John sells 3 photographs for $175. John has had a similar results from this activity in the last 5 years. So obviously that he's not making any money. And so it doesn't sound like it's a business. So since it's not a business, he can only deduct expenses up to his income. He only sold 3 photographs for $175. So all he's going to get to deduct is $175 of expenses. And those expenses would be miscellaneous, subject to 2%. So we're going to go ahead and take those photo expenses of $175. Actually, that's all we can take. He had more than that, but he can only take them up to his income. And then they also had a $900 tax prep fee that they can deduct. Okay, So it looks like that represents all his Schedule A items. And it actually looks like that's all we have. So let's begin to get his AGI, and then we can go from there. Okay, we had the $186,800 plus our interest of $13,075. Now remember, he had photo income of $175. Now when it's a hobby, the income goes on the front of the return and the expenses go on Schedule A. So the total income is $200,050. Then he had $33,600 of alimony. That's going to reduce his total income to get to his AGI. And so now his AGI is $166,450. $166,450. We want to carry that to the front of the return. I'm sorry, to the second page. $166,450. And our next line item is our itemized deduction. So let's go here, and we're going to put the $166,450 here. 7.5% of it is $12,484. So he's not going to get any medical. He's going to get the $10,200 there. And then he's going to get his $19,700 of interest. He's going to get $11,150 for his gifts to charity. And then we're going to add up. He had $1,075 of miscellaneous. We're going to put his AGI there. 2% of that is $3,329. So he's not going to get any of those. And so then what we would do is we would end up totaling up his itemized deductions. He would get $10,200 plus $19,700 plus $11,150. So ends up with $41,050. The question is, it says, is 1040 line 38 more or over 159,950, which is, it is. So in that case, yes, he's going to be limited to his itemized deductions because of his income. And there's a form that they have in your book for you to fill out that itemized deduction limitation, And so $41,050 is the starting point. I'm going to blow that up so you can see that. Okay. And then we would zero there. Then we would have $41,050. And then they have a number of calculations, which because of time I'm not going to go through. But remember our calculations in which they are limited to, you take the excess over it, and then it's certain itemized deductions. So go back and read that. But let me go ahead and give you the amount. The amount that he's going to end up getting is $40,985. $40,985 is going to end up being what his itemized deductions are. So given that, $41,000, he can't get that. He's going to get $40,985. So definitely go through those calculations and see if you can get that same number. And so we go back here, and then we're going to put our amount that we actually get, the $40,985. Uh-oh. $40,985 there. And so then we get $125,465. And then 42, it says, is line 38, is his AGI over $119,975? His is. And so he has $3,500 for an exemption, but he is going to be limited to the amount of exemptions he can take. So there's a form that they give you for your deduction for exemptions so that you can go through the calculation. And remember, it's another calculation that we have to do. And we would start with the $3,500 here, go through the calculations, and that's, remember, where you take the excess divided by 2,500, whatever that number is, you round it up, multiply it times 2%, and so you go through that calculation, and I'm going to give you the answer. You would end up with $3,430 that he can take. So he loses $70 of his exemption. Okay, so that's what we want to put. His exemption ends up being $3,430. And so now his taxable income is $122,035. $122,035. Now, because he is over $100,000, his income is over $100,000, then he can't use the tax table. He has to use the tax chart. The very back cover of your book gives you a tax chart. And I want to show you and kind of talk you through this calculation, and then I'll help you with the answer. He was single. Okay. He was single, and so you would go to the single individuals chart. Okay. Single individuals, and his taxable income, let me get to what that was. His taxable income was $122,035. So that's between the $78,850 and the $164,550. So to get his tax, what you would do is you would add $16,056 plus 28% of the excess of his taxable income over $78,750. So you would take his $122,035 minus $78,850, then multiply that times 28%, and then let's just do that, and then add to that $16,556.25. So let's just kind of do that calculation. Here we said we would take his income of $122,035 minus the $78,850, and we get $43,185 times 28%, and you get $12,092 if I round it. And then they want me to add to that $16,056.25. And so then I end up getting his tax ends up being $28,148. $28,148 is his tax. He has no other additional taxes or anything, so we just kind of carry that number on down. Okay. Now he owed $28,148. He only paid in $24,800. So in this case, he would owe an additional. Would need to pay with his tax return $3,348 would be the amount that he owed. He does not have a refund. He can put his tax return, his bank account number, and they would automatically take it out, or he could send in a check. Okay, so those were three really good problems that we took some time to go through. So I would make sure if I went too quickly, you go ahead and do them. Check the answer that I'm going to post online, and go ahead and begin to read Chapter 6. Our next session will be credits, and that's it.